Hi everyone, welcome back. You might have a DB, final salary pension, that's starting sometime in the next few years, but you're not ready to stop working just yet. What if I told you there's a smart way to take that guaranteed income to make it work harder for you while you are still working? That's the subject of this video today, so let's dive in. Welcome back to all regular viewers and subscribers. If you are new here, my name is Dianne, and I'm qualified in advanced financial advice and support people to achieve their money and life goals. What is the DB pension and why people defer them? I will very briefly cover what a defined benefit or DB pension is in case you're unsure. There's more details on the screen right now. These types of pensions, where you get a guaranteed income for life from your normal retirement date, are common in public sector jobs. They are relatively rare in the private sector these days. So as an aside, if you haven't looked for old DB pensions that you might have forgotten about, please do so. And DB pensions often start at age 60 or 65. And if you are still working at that normal retirement date, then the most common approach that most people automatically assume is the right one, is the best one, is to defer the start of taking that pension until they are ready to retire, because most will allow you to take a higher income if you start taking it later. In short, the most common factors why people think that it's best to defer the start date is because they will take a big tax hit if they take the income now. They realise it might take them into a higher tax band, or if they are already in that high tax band, think, what's the point of taking it now because I'm going to lose 40% of it? Or they think it's better to defer because they get a greater annual amount at a future date. But what if you kept working, didn't defer, took the DB now, and ended up better off overall? The pension while you work trick. Now, I'm sure many of you watching are already doing this, and you are perhaps screaming at the device that you're watching this on that this is so obvious to you. Well, unfortunately, this isn't obvious to a lot of people. I have many clients coming to me wishing that this is something that they had done much sooner, because nobody had explained this to them and they hadn't realised. So instead of deferring, you take your DB income now, use this income to fund your DC pension contributions. That could be a workplace pension or a SIP, and then claim the tax relief or simply use salary sacrifice, whichever is available to you. So let's bring this all to life with a case study. Meet Tom. He's 60 years old, he's a senior manager at a small engineering company, and his taxable income is £65,000 per year. He has a small DB pension from a previous employer that was frozen in 2010, and the normal retirement age for this pension is age 60, so he can start taking it right now. This gives him a guaranteed inflation-linked income starting at £9,000 per year. But when Tom came to me, he explained that he's really enjoying working still, and he doesn't really want to stop until at least the age of 65. He really feels that he doesn't need the extra DB income right now, and more than that, he thinks, what's the point of taking it anyway? Because he's a higher rate taxpayer, he's going to lose 40% of it to tax anyway. And furthermore, if he defers, he'll be starting on a higher amount. On the surface, this logic is telling Tom that it makes sense to defer, and that's a common conclusion that many people come to. But what most people don't realise is that you can actually come out ahead overall by taking the pension now and investing it in a smart way. And as with many things when it comes to personal finance and retirement planning in particular, it's not just about the numbers for Tom, it's about his broader objectives and the broader goals that he has for his retirement. What happens if Tom defers? Now, Tom's particular scheme doesn't offer any specific special bonus for deferring. You might find that's common to yours as well. Again, please do check the details of your DB scheme. In Tom's case, the increase is 2.5% per year for deferring. There's no special bonus. So at age 65, Tom would be starting on £10,000 per year. On the surface of it, that looks like a win. It's an extra £1,000 per year. But here's the catch. If Tom defers, he's missing out on 5 years' worth of income, a total of over £45,000. One of the basic questions for Tom to ask himself is it worth giving up £45,000 worth of gross income in exchange for £1,000 a year more in 5 years' time? Taking these figures at their gross amount, that would mean that Tom would need to live another 45 years after the age of 65 to break even. We can safely say that for Tom, he's ruled out the deferral on the basis of the break even, but he's still worried about the tax impact of taking his DB now on top of his salary from his job. What if Tom takes the pension now and reinvests it? Here's what I went through with Tom to open his eyes to a different scenario of what it could look like if he started taking his DB now. I'll go through year one in detail. The numbers for subsequent years are in the table on the screen. His DB starting income of £9,000 is taxed at 40%, and so that's a net income of £5,400. That would be his annual contribution into his SIP, which receives an automatic 20% tax relief through the SIP platform provider. Then Tom would need to get the additional 20% rebate through his self-assessment tax return, making the total annual contribution into his SIP of £8,100 in year one. Note that if you are a higher rate taxpayer and you are paying into a SIP through your net pay as opposed to through your gross salary, then you only get the 20% as the automatic top up, and then you have to remember to claim the additional 20% through self-assessment, but that doesn't automatically go into your pension. You get that tax rebate and you have to pay it into your pension. Here are the total figures for all of the different categories for Tom. And it means that after 5 years, he could be topping up his SIP somewhere in the region of £45,000. And in Tom's case, he already has a workplace pension that is currently valued at £650,000. And remember, that's in addition to the DB pension that he will be continuing to receive at that point. And at the age of 65, if he does end up retiring at that age, well, he simply starts taking that DB as income instead of paying it into his pension. Here's a table on the screen right now summarising the details for deferring or not deferring in Tom's case. Other scenarios Tom considered and why he excluded them. Like all my clients, Tom's decision making was not just about the numbers. It was about broader considerations, such as what he wanted to achieve in the final years of his career, what he had planned for his retirement, the degree of flexibility that he wanted to have with his money, his attitude towards investing, and so on. It's so much bigger than just the numbers here. But what I was able to do with Tom was help him decide which course of action was the right one for him based on laying out the numbers and then discussing these broader factors with him as well. For example, one of the additional scenarios that we looked at, which I haven't gone into any detail here, was taking tax-free cash from the DB scheme. And the other obvious option was taking the pension now and spending it rather than investing it. But as I've said, in Tom's case, he was a very careful saver. He's not a spender, and he really felt that his current income was covering all his needs. And he genuinely felt that he didn't need more income, and he definitely didn't want to spend it. And that was one of the key reasons why he didn't really want to take it in the first place and wanted to defer it. And I'm sure that there are many other scenarios that you can think of why this matters. Tom's final decision making was based on what he valued the most. It was really personal to him, as should your decision making. So Tom has made the decision not to defer, to start taking his DB income and invest it in the SIP, which of course opens a whole other conversation about how Tom is making his investment decisions for this DB income. That can be a subject of another video. So just because you are still working doesn't mean that you should necessarily defer your DB income. You can take it, put it to good use, and end up being better off overall. Even if this video doesn't relate to your specific circumstances, hopefully you can still apply the principles. If you have got to this point in the video and you're not already a subscriber, then the YouTube algorithm will keep presenting my videos to you through your YouTube feed, irrespective of whether you click the button or not. But it really helps me out if you take a second to click the subscribe button. It's completely free. Thank you so much. And finally, there's a link in the video description where you can request a free call with me if you are interested in financial coaching with me. Thank you so much for watching. Until next time, hwyl fawr am y tro.